My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I love talking about dividend investing. I work with a few people that are interested in investing, but usually it's about crypto. We sometimes talk about, GameStop and Tesla, but it's never like there's nobody on my team at work that gets really excited and says, I'm all in on Coca-Cola or I'm all in on 3M or Johnson & Johnson. It's just not as sexy of a topic. And the majority of people that I do work with are, maybe in their early 20s, early 30s. And dividend investing is not really widespread with that age group. Now, a lot of you following the channel, you may be in your mid 20s, early 20s, 30s, 40s, 50s, whatever. And you're probably watching this video because you're interested in dividend investing. And I absolutely love talking about dividend investing. I talk about it with my wife constantly, and I'd probably drive her crazy. And you probably do that with your partner. If you're a diehard dividend investor and you love, the topic, you probably drive your partner crazy as well. So in today's Review My Pie, we're going to review 4 portfolios. The first is going to be from a 36-year-old here in the United States. The second, a 20-year-old here in the US. And then the third, a 20-year-old in Lithuania. For those of you that are not familiar, Lithuania is a European country right next here to Poland, Belarus, Latvia. And yeah, if you didn't take away anything else from this video, now you know where the country of Lithuania is located on the map. The fourth portfolio is a 41-year-old here from the United States. As always, the timestamps are in the description below, and the portfolio links, if they're included, they will be in the description below. As always, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, I'm not pre-scripting or pre-reviewing the portfolios ahead of time. I'm reviewing them live for the first time. So I was thinking the other day, I'd really like to interact more with all of you that are following the channel. And so in order to do that, I was thinking, to make it a little bit different than what already is out there and what other channels are already doing when it comes to dividend questions, what I was thinking is I'd really like to make it personal. So if you would like to submit a question, a video question, I would be happy to answer or respond to it in one of my future videos. So what that could potentially look like, if you have a smartphone, a tablet, whatever, you can take a selfie and ask your question, and please keep it less than 30 seconds and, share your name, where you're from, here in the United States or international. And I'd be very happy to respond to your video questions in a future video. And I don't even know if that's going to be something that people are interested in, but if you are comfortable sharing your video and having thousands of people view it, send over your video here in the email in the description below, and I'll be happy to respond in a future video. And my channel is really geared towards new investors, so really don't worry about, there's no stupid questions, there's no dumb questions, right? So feel comfortable to ask any question that you want. It can be dividend related, it can be financial independence related, it can be related to my wife and I. If you want to learn more about my wife and I, very happy to answer any questions that you have. And once again, there's no stupid questions. Well, there are some stupid questions. For example,
You probably get this a lot. This isn't the real Caesar's Palace, is it?
What do you mean?
Did Caesar live here?
No.
I didn't think so.
well, I guess this could also be considered a stupid question.
What's the best kind of firework to buy?
Wouldn't you like to know, weather boy?
Where are your parents? Kid's sketchy. Back to you guys.
Oh my gosh, that's hilarious. All right, the first portfolio here is from Erik. Erik writes, "Hello Jake, my name is Erik and I love your channel. I'm very inspired by your work and expert opinion on dividend stocks. My strategy transformed completely after watching your videos." Erik, thank you so much, man. I really appreciate the kind words. I'm still not a complete expert. I still am, I'm learning every single day. So I appreciate the kind words. So your age, you're 36 years old. Your goal is to retire or only work part-time by age 50. I'm currently paying off debt while saving for my future retirement. I have a snowball debt reduction plan in place that should leave me completely debt-free by 2030. I contribute between $500 and $1,000 a month to savings and have a total portfolio of $22K between all of my accounts. When you say savings, I'm assuming your investment accounts. I trade both long-term 40% and medium-term 30% and swing plays 30%, but I keep them in separate accounts, M1 Finance, Fidelity, TD Ameritrade, respectively. respectively. My swing trading allocation has gone up to 30% only because it has been growing exponentially, but normally it should be around 10%. I'm working on a cash position to get back into rental properties, and I also collect commodities. Respectfully, Erik. Okay, well, Erik, this is awesome. So you're 36 years old, so that you're trying to at least get part-time or retire entirely by the age of 50. Okay, so that's going to give you about 14 years. So that's important when we're looking at the different kind of investments that you have in there. And what's incredibly important here is when you have that goal, it's important that you understand, okay, is your goal to buy and hold? Or is your goal to buy and then sell at a future date? Because those strategies are pretty different. If you're going to dollar cost average into Coca-Cola, that's going to look very differently than if you were to average into, maybe something like QQQ, a NASDAQ index ETF, for example, or a growth ETF, or a growth stock like Microsoft or Nvidia. So understanding what your goal is, are you a buy and hold investor, or are you doing a little bit of a mixture, a balance of both? But that's the most important thing is understand what is your goal. Are you buy and hold, or are you buying low so that you can sell in a future date and then reposition into other assets? I get asked that question all the time. Well, Jake, I'm in my 20s. Wouldn't it make sense to buy growth now and then sell later and then reposition into value? Yeah, that strategy can work very, very well. There are things that you have to consider. For example, which account you're holding these in. If you're holding them in a Roth IRA, for example, that is the most optimal because then you're not paying any taxes in that big lump sum in the future. But it really comes down to your personal situation. All right, let's take a look at your portfolio. Erik's dividend pie. I love it. You're up 193%. That is incredible. You have a low expense ratio. You have a decent dividend yield. You're beating the S&P 500 and you have only 24 holdings. You have cash flow and you have ETFs. Let's take a look at your cash flow slice. You're up 174%. You got 20 holdings. Here you got it broken down into individual sectors. So you got technology at 18, healthcare 14, utilities, communication. The big thing that I'm looking for is you're not focused on one specific sector. And really, you didn't specify in your email what your ultimate goal was, if you were to buy and hold or to buy and then reposition and sell later. So let's take a look at your technology stocks. Let's see, what companies you have in here. Microsoft and Apple. I don't think anybody can go wrong investing into Microsoft and Apple. And it sounds like you're dollar cost averaging. These are companies that you can dollar cost average into for 10, 20, 30 years, and they're still going to be great, great companies. I love Microsoft and Apple because they're sticky. They have sticky products. When a business acquires or procures their products, they're usually a customer for many years to come. So that's what I really like about Microsoft and Apple. Let's look at healthcare. You got Johnson & Johnson and you got AbbVie. Yeah, this is absolutely fine. I like Johnson & Johnson. AbbVie's a little bit high, but this could be, it really could depend on your strategy. As a company, I really love AbbVie. I have AbbVie really highly positioned in my portfolio as well. It's a great company. High dividend, over a 4% starting yield. Really good. It's nowhere near as diversified as Johnson & Johnson, but it has a really good dividend. Let's take a look at your industrials at 12%. You got Honeywell, 3M, and Lockheed Martin. Yeah, these are fine. Lockheed Martin, I'm trying to think, obviously I really like Waste Management. I like Caterpillar, but Honeywell, 3M, Lockheed Martin, great companies. Utilities, you got NextEra Energy. There's your Waste Management. Waste Management in the wrong slice, but not the end of the world. Southern Company is good. I also like Duke Energy. I mean, that could work. That could work fine with NextEra Energy and with Southern Company. I do like them a lot. Consumer staples. Let's see what you got in here. You got Walgreens, you got Starbucks, and you got Procter & Gamble. Staples. I mean, I guess you could call Starbucks a staple. Some kind of consider it as a discretionary, but yeah, Walgreens. I like, as consumer staples, this is my favorite slice. I really like consumer staples because they're tangible. When I go to Target, when I go to Costco, when I go to wherever, I see the products on the shelves and I have that relationship. I have that brand recognition with these companies. I love investing into companies that I'm familiar with. I love investing into Kellogg's, right? I love my Kellogg's cereal. Something that I would recommend you do, and everybody watching the video, is the next time that you go to the store, the products or the items that you're purchasing, you're putting in your shopping cart, look behind and see who's the distributor. What brand is this? You're going to be surprised. A lot of times it's going to be larger companies like Coca-Cola or PepsiCo that are distributing these products that you're buying. And those are the type of companies that I love to invest in. All right, now let's take a look at your discretionary. You got 3 in here. You got Home Depot, Target, McDonald's. I think these are absolutely great. I mean, Target has just blown up insane these last, like if you look at Target here this last year, look at this. Target up 92% in a year over the last 5 years. Like, this is like Microsoft, right? This is incredible. Absolutely incredible. I'm a huge fan of Target. I think, wow. I mean, this is just incredible. When I was buying in Target a couple of years ago, they had I think it was like a 2.5%, 3% dividend yield. The share price has just gone up so much. They've also increased their dividend a lot, but holy cow. All right, let's take a look at your financials. You got Visa, you got JP Morgan. Yeah, I think that's the big thing that I'm looking for is you're looking for really established companies. And this is what's important when you're focused on cash flow, right? The title here is cash flow. So if you're looking for cash flow, you want to make sure that you're in stable businesses. And let's take a look at the last one in communications. You got AT&T and Disney. Yeah, I mean, AT&T is now a pure telecom company. Once they complete the spinoff of their Warner business, it's going to be a telecom company. Disney, great long-term. And I've already shared my thoughts on AT&T in the past of why I sold out of it. But in terms of getting telecom exposure, yeah, AT&T and Verizon are still some of my favorites. Now let's take a look at your other slice, your ETFs. You got 4 in here. You got VTI, you got VWO, you got SHD, and you got ARK. Okay, so you got a good balance between broad-based stock exposure here in the United States. You have broad-based exposure to international markets with VWO, and you have one of my favorite dividend growth ETFs in SCHD. This is absolutely incredible. And you have the ARK Innovation ETF. I really like the ARK Innovation ETF as a hedge against your other holdings, right? The ARK ETF is a hedge against, Coca-Cola, against, Johnson & Johnson and these other slow growers. This is a good hedge. And I kind of like that. But yeah, I think this is absolutely fine. Well, Eric, thank you so much for sending over your portfolio. I like that you have your ETFs separate from your individual companies. I like how you have your allocation set up. As you near or get closer to retirement, you can always adjust that. One big tip that I would share with you is don't try to update your percentages every other week, right? Don't do that. That's not, in my opinion, the best way of going about a passive income portfolio focused mostly on cash flow. This is a portfolio that you would want to update maybe on a yearly basis. Thank you so much for sending over your portfolio. All right, the second portfolio here is from Steve. Steve writes, "Hi Jake, I'm really enjoying your videos and I've gotten into dividend investing because of it. I am a 20-year-old college student and I currently have the goal of not working until I'm 60. I am hopeful with the dividend growth I can have passive income by 45 and live off of that. In August, I opened a Roth IRA. In my Roth, it is in 4 index funds focused on the total stock market. I'm at a crossroads in deciding whether to put my dividend growth stocks in a Roth or normal brokerage account. I plan on taking dividends out at age 45, so Roth seems like it doesn't make too much sense, but 25 to 35 years of untaxable growth is a lot of gains. Also, if I do make over 130 in the future at say around 35, then I won't be able to contribute to a Roth anymore. I'm curious to know what you think. Also, after looking at my pie, do you recommend me having 30% in ETFs or should I solely focus on investing in individual stocks? Thank you, Steve. Well, Steve, there is so many great things in here that I want to share with you. I think the fact that you already have this goal as a 20-year-old college student, you are really in the 1% of people in America and globally that are going to be in the position to have the choice. That's what it's all about. It's about the choice of whether you work till 60 or not. So let's unpack this a little bit with the Roth IRA. I think the Roth IRA is one of the best vehicles to investing that there is out there. So if possible, I always think it's a good idea to invest into a Roth IRA. I think a Roth IRA is one of the best things that you can do. Now, when it comes to your question of if I make over 130K, you're not going to be able to do that. That's assuming that you're filing your taxes single, right? That's different if you're married, filing jointly. But I will tell you there is a legal backdoor way that you can do that. This is a legal term that's in the tax laws that you can, I'm not going to cover it in detail in this video, but all you have to do is Google backdoor Roth IRA and that will solve your problem that you have there. So Google backdoor Roth IRA and you'll be able to invest into a Roth IRA. After you Google it, you can thank me later. When it comes to investing into a Roth for your dividend income or investing into a taxable account, I think I would try to find a way that you could do both, where you're maxing out your Roth IRA, but also investing into your taxable account. You're probably really thinking about the taxes when it comes to your portfolio, Roth IRA versus taxable account. What I would encourage you to do is go over to my channel and take a look at this video. Pay zero taxes in early retirement. In this video, I don't talk about the Roth IRA. I talk about the current tax laws that we have here in the US and how you're going to be able to pay zero taxes in early retirement up to a certain threshold. This video will really help answer a lot of the questions that you have regarding Roth or not Roth. And then what I would recommend you do is go and watch this video when it comes to the different types of investment accounts, your Roth IRA, your individual account. I go into detail about the different types of taxes and how each individual account is handled. So these two videos are really going to help answer a lot of the questions that you have. And I'm sure there's a ton of you out there that have very similar questions. And then when it comes to your last question here with the ETFs, 30% ETFs, should you solely focus on that or not? I think it really comes down to your risk tolerance. It does not hurt if you focus more on ETFs now, and then as you get more experienced and you learn more about your investing and your risk tolerance, then you could then invest more into individual stocks. Well, Steve, let's take a look at your portfolio. You're up over 217% over the last 5 years. This is not calculating the reinvestment of dividends, obviously. You have a starting dividend yield of just under 2%. You have a very low expense ratio. You have 58 holdings. 58 holdings is quite a number. The big thing about this is make sure that you know what every single one of your companies does and how they generate their revenue. 58 holdings is a lot if you're unsure if you should hold ETFs or individual stocks. So you may want to do some trimming of your portfolio now while you're still early if you're unsure about some of these businesses. That's just my personal opinion. So you got 30% into ETFs, you got 17 technology, real estate, and all the way down here to materials and energy. The cool thing about M1 Finance is all you have to do is edit the pie and you can update this to 50%, 70%, whatever you want. And then if you wanted to change it a year from now or 2 years, all you have to do is edit the pie and reduce it. So I wouldn't, you pick the right brokerage in M1 Finance to adjust it. And because it becomes very passive, M1 Finance does it for you. So let's take a look at your first slice. You got DGRO, great. DGRW, great. SHD, VYM. These are all really great ETFs. And I like that you have it focused more on growth. DGRO and DGRW are focused more on growth, where SHD and VYM have a higher yield. So this is exactly how you should be having your portfolio set up. This is really good. Technology, you got VGT, Microsoft, Apple, Visa, Square, Tesla, Facebook. Yeah, this is fine. I think, you know what? This is fine. I like it. I like that you have VGT at the top. I like it. Your real estate, you have it at 10%. This is good. You got Stag. Man, you must be following my channel. This is so great. Stag is, all 5 of these are amazing. Stag is a great industrial REIT with triple net leases. We just talked about triple net in my last video. Really cool. It's an industrial REIT that pays a monthly dividend. American Tower is a great cell tower REIT. Prologis, also another great high growth industrial REIT. Prologis, really good. DLR is really good. Digital Realty Trust, it's a data center REIT, and Realty Income is your, the cream of the crop when it comes to retail REITs. When it comes to your age group, I think these are great. I like that you have the growth in here. Stag is also a good growth one. Once you get closer to retirement, that's when you're going to want to look at, REITs like Omega Healthcare, right? Where they have over, I think it's like a 7% dividend yield. That's when you're going to want to look at your WPC with over a 5% dividend yield, and these other healthcare REITs and other REITs that have a starting yield of maybe 5, 6, 7%. But as it stands here, I really, really like that slice. Industrials, you got your Waste Management, Union Pacific. Man, every single one of these are great. Okay, UPS, Lockheed Martin, Caterpillar, absolutely love it. Your consumer staples, you got McCormick, great. This is a great growth one. Costco, Home Depot, Kimberly-Clark, Pepsi, all great established companies. I like that you have Coke here down towards the bottom. Costco, Walmart's even another really good one. But as it stands there, I think those are great. Discretionary, you got, oh my gosh, I promise I'm not looking at these in advance. Walmart, you have it there. Target, McDonald's, Disney, Nike. Man, this is a great portfolio. These are really well-known, great companies. Healthcare, Johnson & Johnson, Stryker, Abbott, really great. Pfizer, United Healthcare, Medtronic. Man, these are such great companies. This is a really good slice. 58 holdings. It's very similar to how I had my portfolio set up before I had my 5-year timeline. So this is very similar to my original portfolio that I set up here on YouTube. Let's see, what do you got? You got your healthcare, we just looked at that. Telecom, you got your Verizon, AT&T, and Comcast. Yeah, great. I would then personally bump up Comcast and lower Verizon. That's just my opinion. And then maybe in 5-10 years, you could adjust this weighting and change it up. But for now, I would bump up Comcast. That's just my opinion. Finance, JP Morgan, American Express, Morgan Stanley, Bank of America. Yeah, these are great. Others that I like are I like SPGI, Standard & Poor's, for example, is a really good one. I really like T. Rowe Price. Those are some good ones that you could take a look at. Utilities, NextEra Energy, Duke, Dominion, Essential Utilities. These are all great. I really like the allocation as well. I really wouldn't change much. Materials, Energy, Sonico, great company. Procter, PPG, great. International Paper, great. Chevron, great. Air Products and Chemicals, great. So what you could even do, these are really great growth companies as well, right? So the dividend yield is kind of skewed because of Chevron, but Air Products and Chemicals, PPG, like these companies are really great growth companies as well. You could even increase this, maybe not now, but the companies are great. Maybe in 5 years, you bump this up to 4%, 5%. Whatever. But the companies that you have in this slice are really high quality. 58 holdings, it seems like a lot, but every one of these holdings are so great. These companies are ones that you can invest in and go to bed at night and really feel comfortable. So I guess, Steve, the last thing that I would say, and I don't want to repeat myself too much, but it really comes down to your risk tolerance. Depending on if you were invested during the crash here or the crisis during the pandemic, a lot of new investors learned something about themselves. They learned about their risk tolerance. If you started investing in maybe, let's say, late May, April, May, all you know is up and to the right? But if you invested before the crash, or if you invested during the, you said you're 20 years old, so you probably not, but maybe your parents or somebody that invested during the dot-com bubble or the financial crisis of 08 and 09, you learn something about yourself as an investor and your risk tolerance during market downturns. When the market only goes up, you don't really learn anything about yourself. Everybody can invest in a bull market. That's the thing that I would say is don't look at other people and see, okay, well, they have their ETFs at 50% or 80%. That means that I should do that as well. It really comes down to your personal risk tolerance, and it's so individual. And I hope that helps. Thank you so much for sending over your portfolio. All right, the third portfolio is from Mantas. He writes, hello there. I'm currently 28 years old from Lithuania, Europe. My plan is to start living off my dividends, hopefully in the next 20 years. So the goal is 20 to 25K per year from dividends to achieve that. Sadly, due to some restrictions on trading 212, this is a brokerage outside of the United States for everybody here in the US, I had to set up multiple pies instead of one to be able to invest 150 euro the month that I am able to do at the moment. If I set up everything in one pie, I have to invest at least 200 euros per month. So I will break down the sectors and allocation that I have set up at the moment. Okay, well, no problem. So you got your tech at 20, real estate at 25, finance, indexes, consumers. Okay, so we'll take a look at all of these here briefly in just a second. The plan creating this portfolio is to get a 4% dividend yield and at least 10% dividend growth rate. Wow, that is a hefty goal. 4% with 10% dividend growth rate. Wow. Okay, I've managed to get 4% dividend yield, and looking at historical performance, I get around 15% dividend growth rate. Wow. Okay. Plan for now is to pay out my credit card debt and car debt while still investing, and in 2 years, I should be able to triple my monthly investment amount if everything goes well. In addition, I have created my own YouTube channel to learn more about the stock market and myself, and to inspire people who have lower income like me to start investing as well. And I get lucky enough to earn some extra money from it someday. I will be putting it all into investing as well. We'll be glad to know, what do you think about the portfolio? All right, well, Mantas, thank you so much for sending over your portfolio. I think, your goal is great. I love the fact that you have it pinned down to 20 years. You have a dividend goal of 20 to 25K per year. One thing that I would recommend is make sure that you look at the inflation rate in your country, or what the historical inflation rate has been over the last 20 years. Because $20,000 today is not going to be you're not going to have nearly the same buying power as in 20 years. So very, very important. That's the one thing that I would note. Double check on your inflation in Lithuania. All right, so let's take a look at your first slice here. The technology one, you got Broadcom at 60, Cisco at 20, Qualcomm 10, Microsoft, and Apple. Okay, yeah, the only thing here is for the next 20 years, you have to understand that you're going to be paying a bit of a higher tax rate on the dividend. If your tax laws are the same over there as they are in the US, you're going to be taxed the entire time while you're getting this high dividend. That's the one piece of the puzzle here that you have to understand, is if you're focusing on that high yield today, you're going to be paying the high yield today. And so, but I think you have a good plan with the dividend growth rate. So it sounds like you know what you're doing. You got Realty Income, you got Crown Castle, and Digital Realty. I like all three of these companies. The only thing is you're not very well diversified. You're only diversified into 3 sectors, and I believe there's 12, there might even be 14 real estate sectors, and you're only getting exposure to 3. So that would be my recommendation, is maybe broadening out a little bit more exposure to other areas in real estate. And most importantly, because this was your largest slice, right? You had 25% allocated to this. So you're going to have a lot of exposure to Realty Income, which is not necessarily a bad thing, but in terms of diversification, I would highly encourage you to look at broadening out this slice. You're going to have a little bit overexposure to Realty Income. Your finance slice, you got JP Morgan, you got Bank of America, American Express, and you got Main Street Capital. Yeah, these are fine companies. JP Morgan is a great bank. I like that you have it at the highest allocation. Let's take a look at your ETF. You got the Vanguard S&P 500. Okay, great. I think that's absolutely fine. I don't think anybody can go wrong with the S&P 500. The thing that I love about it the most is it gives you flexibility down the road. And the thing that you have to be aware of is you're going to get average market returns, and you're going to see the fluctuations, the ups and downs with the market. So your consumer slice, you got Philip Morris, you got Starbucks, you got Coca-Cola, and you got McDonald's. Okay, one thing that I will say, now, this is a sin stock. A lot of people are not fans of, they're not a fan of sin stocks. But the goals that you're looking for, that 4% dividend yield, that high yield, plus the high dividend growth rate, Philip Morris, Altria Group, these sin stocks, they're the ones that are really positioned well for that dividend growth and the high payout rate, the high dividend. But once again, not everybody is a fan of sin stocks. Let's see, you got AbbVie, Pfizer, Gilead. Okay, great. AbbVie is awesome. Pfizer is great. This AbbVie has exactly what you're looking for, over a 4% dividend yield with over a 10% dividend CAGR. All right, now let's take a look at your utilities. You got Dominion, Southern Company, and Nexter Energy. So these are all three great utilities. One thing that I would note with Dominion, they just cut their dividend. If you look at their historical charts, yeah, Dominion would have a 4% dividend yield with over a 10%, I believe, dividend CAGR, or roughly around there. That's no longer the case today because of their dividend cut. So something to be very aware of. Let's see here. You got your telecom, you got AT&T and Verizon. Yeah, these have a higher dividend yield or starting yield, but they have lower CAGRs. So dividend growth, compound annual growth rates of the dividend. And I think with AT&T, it's going to continue to be low, despite their spinoff. So let's take a look at your industrials. You got 3M, Caterpillar, Lockheed Martin. Yeah, these are great. 3M, with everything that's going on in the economy right now, 3M has really exploded these last couple of months. But when you look at the yield on cost, if you've been buying into this for over a year now, you have a really, really strong yield on cost. Let's take a look at your oil here, your last slice. You got ExxonMobil and you got Chevron. Yeah, these are going to continue to do well. I don't know what's going to happen to them in 20 years. I think, there's a lot of talk right now with Exxon. I think they have a new board member from the renewable energy sector. I can't remember the name, but I think that they're expanding more into renewables. And I think it's becoming more and more of a focus. And so I'm curious to see how these two companies are going to evolve over the next 10, 20, 30 years. Well, Mantas, thank you so much for sending over your portfolio. I hope that this was helpful. It sounds like you have a really strong plan in place. Now it really comes down to those three things that I always talk about. Over the next 20 years, it's a matter of cutting your expenses, staying out of consumer debt, and looking for other areas or new ways to generate more income. You mentioned you started a YouTube channel that you're hoping to monetize. You could start a side hustle. It's all about those three things while you're looking to grow your net worth. That's what it's all about. Thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio from Dave. Dave writes, "Good morning, Jake. I hope everything is going well over there in Texas. Towards the end of 2017, I found myself in a position where I was homeless and without a prospect of a job. I did have a few things going for me, such as having a laptop and a tablet, which I was able to use to alleviate boredom, and also got my CompTIA Security Plus certification, which was a waste of money I could have used for food. I came across a few ways to make money and ended up writing a couple of books, which I self-published on Kindle. Long story short, I found your channel and began researching ways to never be in that situation again. Luckily for me, COVID-19 came to the US and the government sent out stimulus checks. With that check, I was able to get out of the homeless situation, find a job, working from home, and start on the path of investing. My strategy for this is to be able to live off of only my dividends. So I have two very different portfolios, which I invest in with a 80-20 split. The first is my dividend portfolio, which after painstakingly researching, I found several companies which altogether give me at least one dividend per week at an annual yield of just over 5%. Whoa. I just feel that by doing this, it allows the compounding to happen a little bit faster. That is true. It actually does a little bit. It's not a crazy amount, but the faster your dividends are coming in, they are compounding quicker. So that is a thing, but it's not like it doesn't move the needle that much, but it does move it a little. The second portfolio, which is a straight up growth portfolio, will be used at a stage where I can take the profits from it and send it to the dividend portfolio at some point in the future. Okay, so repositioning, that sounds great. The space tech pie will eventually be ARCX when that IPOs, but for now I have 3 companies in there to start accumulating growth now while I wait. Yeah, that's true. So this email is a little bit older before the ARCX ETF came out. So your thoughts on the strategy would be a huge help. Regards, Dave. So let's take a look at your growth portfolio first. Here in M1 Finance, if it's a recently IPO'd company, it doesn't really show the historical performance. That's why you're saying here this May 31st. So this must be there must be a recently IPO'd company in here, or SPAC even, that is in the portfolio. That's why the historical chart is not showing up. You got 20 in online tech, biotech, EV tech, fintech, all this the fun stuff in here. Okay, so let's take a look really briefly at what you got. You got ARC-W, okay, biotech, you got the ARC Genomic, and you got CRISPR. Okay, these are really good. You got EV tech, you got Tesla, ARC, and okay, interesting. All right, let's take a look at your fintech. You got ARC fintech, and you got SoFi. Okay, cool. Energy, you got Invesco Solar, Lit, Grid, and okay. A lot of these I'm not really familiar with. I'm familiar with the ARC ETFs, but some of these others I'm not as familiar with. I don't spend as much time researching. But you got the ARQ in here. You got the SPACs. You got the Virgin Galactic. Okay, this one's been really interesting. I've been following this one a bit. It's been going up and down. Gaming and social, you got Hero and you got social. Okay, well, Dave, when it comes to your growth portfolio, I can't really go into detail in terms of like the individual holdings. I do like the ARC ETFs in there. I'm a big fan of Cathie Wood. So let's take a look at your dividend portfolio. You're up a little over 30%. You have a 4% dividend yield, a very small expense ratio, 66 holdings. You got 12 slices here with telecom at the highest. That's pretty high. Telecom is pretty high. Industrials at 4%. Okay, let's take a look and see what you got in telecom. Verizon and AT&T. Okay, yeah, they're pure telecom plays. I don't know if you want to keep it at 15%. This would be more so if like if you're looking to live off of the dividend today, like now, then yeah, this could make absolute sense. But if you have over 10 years before you want the dividend income, maybe it's not the best choice. All right, so in your real estate slice here, you're actually up pretty good. Real estate's been just booming these last couple of weeks. You got WPC in here. This is great. I just talked about WPC in my last video. This is a future dividend aristocrat. You even got FRT in here. This is a dividend king. They've increased their dividend for over 50 years. Really, really good retail REIT. You got Stag in here, Realty Income, DLR. Okay, there's some really good REITs in here. These are high quality REITs. Dividend ETFs, you got SPHD, SPYD, and YOLO. Okay, yeah, I mean, they're not my favorite, but they're not the worst. So there's reasons why you could have all three of these in here. My favorite dividend ETFs in a taxable account, for example, are SCHD, VYM, and DGRO. So, but those are fine. Finance, you got Toronto, you got Royal, JP Morgan, Wells Fargo, so your traditional banks. Energy, you got Enbridge, Valero, so just your oil. You don't have Exxon, okay. So I guess the question is why not Exxon? Okay, let's see here. You got healthcare, you got AbbVie, Pfizer, Johnson & Johnson, Medtronic. Yeah, okay, these are fine. Yeah, these are fine. Let's take a look at your technology. Okay, so you got Seagate, IBM, Cisco. You got more of your established technology companies. So you got Oracle, so no Microsoft, no NVIDIA. All right, so you're more focused on your blue chip companies in here. You got a little bit of Apple there. Okay, yeah, cool. I mean, that can work. It's a little bit different than what I typically see, but I think these are all great. They're great companies. Consumer, you got Altria Group, Philip Morris, really strong dividend companies. Aflac is it's a finance and insurance company, but let's see here. You got Walmart, Target, Pepsi. Yeah, these are all really, really great companies. It just Aflac would go in your finance slice. Let's see. You got Aerospace, Raytheon, Lockheed Martin, General Dynamics. All three really, really great companies. You got transportation. I'm not as familiar with these ones, actually. I can't really speak to either of these. I'm not familiar with these. I'll have to check them out. Utilities, you got Southern, Duke, Consolidated Edison, and Nexter Energy. Yeah, these are great companies. Industrials, you got 3M, Caterpillar, Illinois Toll Works, Waste Management, great, UPS, Linda, and Avery. Okay. Well, hey, these are some really, really great companies. You got 66 holdings in here. The majority of them I'm familiar with. I think, the only thing that I would say, Dave, is, when you're building out your portfolio, it can get really exciting, right? And the most important thing that I've learned when setting up my portfolio for the first time is really understanding my goal and then working backwards from my goal. So for example, if I know that I want to tap into the dividend in 10 years, then I want to build the portfolio so that it is best utilized for the next 10 years. If I want to live off the dividend in 5 years, it's going to look very different than, for example, in 20 years. And then understanding your goal, is your goal to dollar cost average? We talked about this already earlier in the video, to slowly, build up your shares, or are you looking to invest into growth and then sell out of and reposition? So those are the most important things. Understand your time frame. Understand, are you a buy and hold investor, or are you buying now looking to sell later? The earlier that you can answer those two questions, the better positioned you're going to be for future success. I promise. Those are the two questions that you really, really want to answer as soon as possible. And then you can start working and building your portfolio the way that it meets and fits your goals. Thank you so much, Dave, for sending over your portfolio. Thank you so much for watching, everybody. I hope that you learned something new. Once again, you can send in your dividend investing video questions to the email in the description below. And I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.